What's up? What's up? Let's get the stream started. I got a lot to talk about today. It was a very exciting week. Lots of things happened, especially in the stock market. We started out this week pretty bad. I remember thinking about this coming in on Friday, which was here on the 16th. Things just went from bad to worse when it came to the way that the stock market played out. Also had some good talk from Kathy and Elon and Jack Dorsey on the B word. We're going to look at a clip from that I really liked here in just a minute. And finally, we're going to look at some trades from this week. Some of the things that me and some of the people in the Discord were trading. There was a lot of money to be made this week. There really was. If you were on the right side of the market, if you were not too leveraged coming into this week on this down move, it scared a lot of people. And really, in the grand scheme of things, it was not that bad of a correction. I want to look at some of those things. I want to look at some of those statistics to what an actual correction looks like or how often they actually happen. And so let's first take a look at SPY. And I want to look at some of the price action that happened when you look at the S&P futures. And so one of the key things that I like to look at is the spikes. And I've shared this with some people before, but looking for these opening spike movements where you have the opening price of the day right about 9:30. Now, if you were trading this into the morning, or excuse me, the last of the day on Monday, then a lot of people well, some people that I've spoken to, they got caught up at looking at too close to the price action. They were just seeing this. They were seeing the market about to tank, and the economy was going to go to crap because Delta variant, and everyone's going to get locked in again. But I guess we cured the disease because no one is worried about it now at all, so it seems. And we just ripped higher to a new all-time high today. And I'm not really that surprised. I'm really, because we are in a bull market. Some people have asked me, how do we know when the bull market is over? Well, I'll tell you, it's when the market is less forgiving. The market was very, very forgiving. There's not much else to be said about it. And so you really have to just continue being long the market until something proves that that is not the way to go. And you'll see it. You'll see it. Or as I've told some people jokingly, when I start freaking out, then you have permission to freak out. But let's look at some of the statistics for the market itself and how often a correction happens. And there's lots of firms and investment places that have research to keep their clients from freaking out. And so there's a number of things from Schwab or Investco that keep people focused on the whole time in the market versus timing the market. I don't completely agree with that because I'm a trader and I'm trying to time the market for outsized returns. But if you're just a standard investor, you just need to be long. Too many people try to outsmart things. They get out before a little correction and then they miss all the gains of the year because they can't figure out when to get back in. Because if the market's ripping higher, the same nervousness that had you get out is going to keep you out of the market. So I saw this right here. Let's go through some statistics first. So if you look at the market going back to the 1960s, this is what a bull market, bear market cycle looks like. Bull markets are very long. Bear markets are pretty short. And so, yes, it's good to miss the bear markets if you can, but you're going to more often than not, as a matter of probability, miss out on bullish days. Just to give you an idea, the statistics somewhere, they fall around this. A correction, which is defined as a minus 10% move. That's any number of days, but a minus 10% move from the high to the low. And if we look at the SPY, that's not what we actually had in this case. This from the high to low is only about 3.5%. We had something actually more pronounced back in March. That was actually a significant move, about 5%. And so the 10%, we haven't even seen it this year. We did last year. The 10% happened actually, in addition to the COVID crash, there was actually a 10% move back in September of last year. It was about 10.5%. So that's pretty standard. And you can look for that to happen once every 1.87 years, or let's say once every 16 months. Or as another way, there's a 60% probability that it's going to happen in any given year, more than half. But the market comes back. And since 1920, on average, the stock market is going to have a 5% pullback at least 3 times a year. So think about that. At least 3 times a year, there's going to be a 5% pullback. Now, that means a lot because that can be a buying opportunity. So there's no reason to freak out when the market drops about 5%. You should really be thinking, what stocks have I been watching that I want to get into? Now, if you really are convinced the market's going bearish, we're going to look at that here in just a second. We're going to use Intel as an example for that. But look for strong stocks that you want to buy and get into them when you get the opportunity. Finally, a collapse, an absolute unmitigated disaster in the stock market has only happened 4 times in the last 120 years. So if you, again, do the statistics and you do the math on that, that means that in any given year, your chances of an absolute market collapse of 40% or more is a little over 3%. Yes, it's not zero, but it's not a high probability. It's kind of outside this 2 standard deviations almost. Here's another way to illustrate it, which I found that was pretty interesting, is this chart right here. Now, this is one of those lifetime bar charts where it's a 78-year average lifespan, and it shows each little green dot represents a day in the life, and each little red dot represents a 10% correction. Now, corrections can take more than a single day, but this is just showing the number of corrections in a given lifetime versus the number of days that the market is actually open. And so blue is, of course, when the market's not open, but out of all of the days that the market's open, the times that you're going to have a correction over the last 100 plus years is about that much. So let that sink in, make it a little bit bigger so that you can see it. This is the probability that you're actually going to get a major 10% correction. And then the yellow is a 5% pullback. It's not unheard of. It's not uncommon, but on any given day, it's not something you need to worry about. One thing that I've learned by doing trading and just paying more attention to market and psychology, especially in the last year, I think people just love indulging in fear, whether it's a new virus variant or it's a new terrorism alert. See, I was growing up back in the aughts, the oohs, the 2000s when we had 9/11 and they instituted a terrorism color alert. And every time the news cycle got a little bit boring or the Bush administration wanted to distract from something going on, they would raise that terrorism level and it'd be on the news and everyone would be afraid of terrorism. We're going to attack their local Walmart. And it was all BS. I mean, I made the prediction last year that for the next couple of years from 2020, you're going to hear virus scares and they're going to amount to a whole lot of nothing. Now, I hope I'm absolutely right about that. I hope that they actually amount to absolutely nothing. But people are definitely going to be more sensitive to that fear. And the same goes with the stock market. People are so afraid of the market correcting, so afraid of losing money that they cost themselves money. And you got to get that out of your head. You got to get that out of your head. So trust that the probabilities are going to be keep you okay. But if you do feel like you need to short this market, I have a solution for you. And it's not buying SPY puts. I'm banning people from buying SPY puts on my Discord. I don't want to hear it. I have seen so many people consistently lose money buying SPY puts. It's frustrated me. I don't do it. Or I would do it in a very select, but no, we're not going to do it. It doesn't work. It doesn't work. You either have two groups of people, you either have two groups of traders. They either buy a SPY put when the market is making a new all-time high. Nothing wrong with that. It's gone up. Surely it has to come back down at some point. Gravity has to take effect. Well, the problem is you might actually be right. But if you buy that put and it keeps grinding higher, you're losing theta and it's getting you up to a point where you're probably either going to have a worthless option because it's expired worthless, or it's eaten away at your resolve and your strategy so much that you just can't hold on to it anymore. It hits your stop. And then once it does that, what's it going to do? Oh, it's going to trick you a little bit. And then it'll finally go in your favor, but it's either expired or you're already out of it because you had to get stopped out. It doesn't work. It doesn't work to try to short the top. Or you see the slightest little bit of a correction. You see some bearish movement, and this draws you in. You're looking at the lower time frame charts. You're looking at a 5-minute. You're looking at a 1-minute, and you see all this bearishness, and you forget that you're trying to short an instrument that looks like this. I just don't see it working for people trying to short the market by doing SPY puts. It's just so low probability. It just doesn't work. But here's what you can do. Find weak stocks. And I'm going to pick on this stock right here because I was actually in uh, Intel up until we broke this right here. I don't want to be in it anymore. there was supposed to be some, 28th generation chip that was going to change. Well, it didn't. Okay. I had a nerd friend that got me into it. That's what happens when you take bad tips. A friend of mine was absolutely bullish on Intel. I got in somewhere, I think in here on this dip and closed it at a scratch. So I'm done. No more Intel. I got better things to put my money on. But take a look at this chart. This was on the same day that we were looking at the SPY. This was on Monday. This stock is not very strong. It's not the SPY, which is going up and to the left. You have something where the last earnings went down. It made a high, which wasn't even really a new all-time high. It's just going nowhere. It's kind of a garbage price action. If you bought a put on this, now I don't support going on the puts with earnings, but if you must buy a put, if you must bet on the market going down, find weak stocks. Don't short the whole market. That's got to be the hardest way to express your trade, trying to go short the entire market with SPY puts. Find weak stocks, stocks that have not been doing well in this run up, stocks that were the darlings of yesteryear, and take short positions. Then, if the market does go bearish, you're going to benefit from not only the stock being weak, but also the bearishness of the market. It's going to drag it down even further. You have multiple more probabilities to win in that situation rather than trying to play the price action on the broader market. It just doesn't work. I just don't see it working for people. I think that people really just need, I hate to tell people what to do directly, but I just see so many people losing money on SPY puts. It's just not working for people. I just don't think you should consider it a worthwhile instrument. I don't. Find opportunities in individual stocks and play them. That'd be my advice there. I hate seeing people lose money when the answer is pretty obvious to me that things are just not working. There are ways to do it, just not that way. Well, before we start looking at some individual stocks, let's take a look at the Bitcoin situation, because I think a lot of people are getting bored with crypto right now. But we had a interesting event this week. Now, the interesting event for me as a trader was, of course, coming down to this low over the weekend and holding there. And why that's interesting is because you're basically holding these lows pretty firmly. And who says that technical analysis doesn't work? Well, people that don't want to follow it when something's going against them is who. But it's holding these levels, and that's good for the bulls. It really is. You do not want this to break the level. The leverage situation, which I think is still the most important fundamental aspect of Bitcoin right now, it's increased. On this move up, more people went long on leverage. There's more and more people trying to YOLO long into crypto, trying to buy this dip, and they're just really lucky that it didn't break this lows. But there are a lot of stops. There are a lot of stop orders. There are a lot of liquidations down in the 28, 27 range. It will not stop there if it drops. A lot of people were saying 24. I actually heard Jim Cramer, he said 12. That's about one of the few times. I mean, I agree with Jim Cramer once in a while, but 12 is actually the number I kind of think too. But it's going to happen quickly, faster than people will be able to react. That's just the nature of things. When these long positions start to unwind, when they start to get liquidated, it's just going to go very quickly. That's the nature of things. Markets grind up slowly because they're done through slow, deliberate dollar cost averaging, people contributing to their 401k, etc. People think about a position. I want to be more long this stock. Let me buy some more shares. Or I want to be long this crypto. They buy a little bit more here. They get a paycheck. They buy some more. Buying something, buying an asset is a slow, methodical, thoughtful process, and that's why assets tend to appreciate slowly. But when you go to sell, it's a one decision event, and it usually happens in a moment of emotion, and that's why they drop so quickly. So not only does emotion create fast drops, but the structure of the market is going to create a massive liquidation event. And so you need to be very aware of this. So just keep in mind, don't be on leverage. in crypto. That's about the best thing I can say to you here. And some of the things that the news was talking about this week was with Elon and Kathy, and there's a B word conference which I highly recommend you watch if you're into Bitcoin. It was actually pretty good. It was, and we're going to play a clip here in just a second. But again, going back to the news and how I loathe how they report on things, they of course reported that Bitcoin was up or crypto was up on that talk. Well, I marked it off here. The talk actually happened at this time at the vertical line. This weekend it did nothing, but what did it do? Price pumped on the expectation that Elon or somebody was going to say something bullish. So by the time that the talk already happened, you had this price volatility here, but didn't really make that much of a difference. Yeah, it's bullish. I would say that it's going up. But when people say it's up on the talk, no, people were buying the rumor. So if you want to think about it that way, it can be pretty good to add to your arsenal. Let's bring up that talk because I liked a little clip of what he said. Elon said. So we'll listen to Elon here.
Elon, how about you? You obviously you're a big personality on Twitter. What are your thoughts on your role and your company's role in Bitcoin and sort of preserving the ethos?
Yeah, I mean, I generally think we should do things that benefit the people as a whole and increase the probability that the future is good. So, I think to me, it just seems self-evident that we should kind of take these set of actions most likely to make the future good. And I think probably crypto or some of the cryptocurrencies will make the future better, most likely. It's not, I always think of these things in terms of probabilities, but I think it's probably better for there to be a prosperous Bitcoin, Ethereum, Dogecoin, maybe some others in the future. And I think it can have an empowering effect for individuals and increase the power of the individual relative to government. And really, if you think of government is just a corporation in the limit. So sometimes some people are like against corporations, but for government. It's like, guys, government is just a corporation in the limit. It's the biggest corporation of all, and it's got a monopoly on violence. So if you don't like corporations, you should really hate government.
There you go. All right. We got about, we'll try to wrap up in 10 minutes. So let's move on to future of Bitcoin. So Tesla and Square have both put Bitcoin on the balance sheet. Kathy, I'm curious to hear from you. What advice would you have for other institutions looking to put Bitcoin on their balance sheet?
Well, I guess the first piece of advice is, just make sure, and I actually learned this after both Square and Tesla put Bitcoin on their balance sheet. The Bitcoin is being treated as an intangible asset. And so we need to get FASB to reconsider this, because with an intangible asset, if the asset goes up in price, it can't be marked up on their books. But if it goes down, it must be marked down. So, there's some asymmetry there, which is, we need to change that given what we believe Bitcoin is. And I do believe if, I'll harken back to something, well, it was either Elon or Jack said, think about it, you take away the boundaries, the different currencies, just think about how explosive growth could be and how wide-reaching taking the friction out of the system could be. So I would encourage corporations to think about that this ability to do business anywhere in the world, ultimately, obviously, we're paving the way here. That's certainly a consideration. It also will serve as a hedge against inflation especially, and as I mentioned earlier, there are a lot of emerging markets that are suffering from significant inflation. In other words, the purchasing power of those populations is going down. So they are going to migrate to Bitcoin and other ways to preserve purchasing power. And again, being able to sell to them in that kind of currency would be very useful. I'd also suggest, once again, this idea of deflation, I think, is going to be a real thing. There's going to be good deflation caused by innovation, so demand will boom because of that. There's going to be bad deflation because so many companies out there have not been investing enough in innovation. Their products are going to go obsolete, as you know, and they're going to be stuck trying to service the debt that they piled on because their shareholders wanted profits and wanted them now. So they leveraged up to buy back their shares and pay dividends, and so I think that's going to be the source of bad deflation and counterparty risk. And we learned from 0809 that counterparty risk can be devastating, almost cataclysmic. So a hedge against that as well, I think, would be another reason to do it.
Thank you. Okay, so I had myself on mute. All right, what I was saying basically is that Elon, love him, and I liked his little quip in there, a very libertarian quip about the role of government and how government is the largest corporation. Putting that out into the mainstream consciousness is pretty cool. Kathy, her comments about Bitcoin being on a balance sheet. You can't take it as an asset because your company can't suddenly be worth 4, 5, 10 times what it was just because of this asset. So that's a real consideration. So on a final note about Bitcoin, uh, from a philosophical perspective, I hope it succeeds. But success in Bitcoin, and whatever you define it as, doesn't necessarily mean that the price has to go up to whatever your target is that's going to make you as rich as possible. It doesn't mean that. From a trading perspective, though, the risk reward, because of the leveraged interest, is just so much greater on the short side. It just is. It could go up. It could appreciate. But the thing is, you're not going to see, you may see a 50% appreciation over the short term, but on the downside to the short term, it could also drop 50%. It's a lot harder to recover a 50% loss than it is to make a 50% gain. So just be very careful. Don't be on leverage. And if you are trading, just remember where the edge really lies. And you know where it is if you've been following the leverage situation. Okay. So I said I was going to pick on Intel because every once in a while I notice in Discord, especially in the Discords last year when you had a lot of new traders coming in, they like to play options before earnings. And I have completely written this off from my repertoire years ago because it just doesn't work. And I want to talk about why it doesn't work. And this is how it conceptually doesn't work for me. Now, a lot of people, they want to play. What I find people want to do is they want to play a company's earnings because they like the company. They have some kind of affinity for it. They use the product, or they hate the company and they think that this earnings is going to finally show how they hate it is going to work. It's a guess. It's a gamble. And I'm not in this to gamble. I will say that I speculate, but I'm not trying to gamble. I don't even like going to Vegas. But playing options before earnings is a gamble, and it's not even a very good one. Let me just simplify it down in terms of probability. So, what do you need to win on an earnings play? Let's say that you're going to buy a call or a put right before earnings, the day before, because you think the stock is going to do whatever. Well, if you buy a call, you're betting on it going up. If you buy a put, you're betting on it going down. It can only do one of those two things. So to start with, your probability is going to be 50-50. You have a 50% win rate just to start with. Coin flip. Now, if you think that you know what it's going to be, well, you don't, unless you're getting insider information, and that's illegal. So let's just dispel the notion you think it's going to be. It's just a coin flip. And I've seen so many cases where a company blows earnings out of the water, and then they get on their earnings call and the stock tanks because they said something dumb, or they had bad guidance, or something to that effect. You just don't know. And even if it's good, the stock can still drop. Or even if it's bad, they can have great prospects for the future and it goes up. Absolute crapshoot, flip a coin. So if it was just 50-50, then maybe we'd be okay winning. But right before earnings, implied volatility gets jacked up because there's an event coming. There's a binary event. There's a shock coming to this stock. There's an actual catalyst that can move it. And so what happens is options price in an expected move. The market, based on the options pricings, expects how much it's going to move. Now, that can be 1%, 2%. It's going to be dependent on the stock, going to be dependent on what news and buzz there is, but it's all reflected and it can be statistically measured in implied volatility through the options. And so the options, they get more expensive to encompass this expected move. And then when the event happens, down comes that implied volatility because it's been realized. So in order for you to win on either your call or your put, you don't need just an up move or a down move. You need a big move to get outside of that expectation. So what do we need for a big move? Well, let's keep it simple. A big move versus a small move. Make it binary. Again, it's 50-50. So you need to be the right on the direction, and you need a big move. So what does that leave you with in terms of probability? Well, it's very simple. 0.5 times 0.5, you're looking at a 25% win rate at best. 1 in 4 of these option gambles are actually going to work out for you. You're already setting yourself up to lose to begin with. I don't want those odds. But people trick themselves into thinking that they like the company or they hate the company and they somehow have an edge in that. No, you don't. Your edge is that 25%. So do you want those odds? I don't. Let me do another illustration. Let me dig into a little bit deeper and show you just how bad playing it is. Let's just say that you pick the right direction. Let's say that you win on this one. You have to think about it in terms of a broader trading strategy. If you're just looking at this to gamble, if you just want to do it for fun, I'm not going to go into a casino and yell at people playing the slots that they're going to lose their money. It's not my place. And plus, I get kicked out. But I will tell you that you're going to lose your money doing it this way, and I'll show you why. You have to look at it in terms of a system. Let's take a look at Intel on the day before earnings. This is using Thinkorswim, Think Back feature, great tool. You can go back and look at options prices for any instrument going back years and years and years. I love it. It's great for back testing. So we're up here looking at 722. That's yesterday. And these are all going to be closing prices, the closing price of the stock and the closing price of options. That's what data you have. Intraday, you can get it, but this is all we need because at the close yesterday, we put on this option, hypothetically, to see if we're right or wrong. So let's do both sides. And let's do it two different ways. Let's say that we wanted to bet on Intel going up. All right, so let's just do the closest to the little bit out of the money, just a little out of the money. So closing price was 55.96. Let's buy the 56 call. We're going to use the weeklies. We're just going to do the 1 day to expiration options because we're trying to just play this. That's all we're doing is playing the earnings. And so we're going to take the pretty much at the money 56 call. Now let's go a little bit further out of the money. Maybe we don't want to spend 160 bucks. Let's spend about half that on a 58 call. Okay, so now we've got two options to see what happens. Now, that's if someone was betting on it going up. What about somebody betting on it going down? Well, let's take the next close to in the money call or at the money call, the 55.5 put. Let's buy that hypothetically. And then let's again go 2 strikes away from that. So that's going to be 53.5. Buy that one. Okay, so now in the back testing, we have these, and all we have to do is click up here and see where we would have closed today. Well, over here on the right, the profit loss open. If we would have taken the calls, well, it's no surprise that we would have lost all our money. So that was not going to be good. That fell within that 50% of us being a winner or loser. But let's look at the closing price of if we were right, if we bet on it going down. Well, we spent 147 or 147 bucks buying the close to at the money put, the 55.5, and we only made $105 on it. So what's the problem with that? Well, the problem is we risked, just as if we had bet on it going long. We bet on it going long. We put $169 on that one. Well, we put 147 on it going down, and we made some money. But if we had gone the wrong way, we would have lost all of our option. So that's a full loss, full value. So if we have to take the full value of the option as our risk, we risked $147 and we made $105. Yeah, we got it right, but we didn't even get a 1-to-1 risk to reward. And remember, what was our probability of success? 25%. So if you only win 1 out of every 4 times, or reverse it, if you lose 3 out of every 4 of these, then you lose, let's say, $150 each time. After 4 trades, statistically, you're going to be down $450. You may win $100 on one of them. Now you're only down $350. If you keep doing this, the only thing you'll succeed in is fun, because that's what you're doing it for, and capital destruction. It's not a good strategy. It's just not. You just don't do it. And hopefully it takes people once or twice to figure this out. But if you look at this from the perspective of a long-term strategy, buying options before earnings does not work. Now, selling premium around earnings, that's something I can get behind because I have done a lot of work and research on those kind of strategies. Those can actually work, doing either a really tight iron condor or even tighter, an iron fly. But that's very nuanced because at the end of the day, anytime you're selling premium, you are picking up pennies in front of steamrollers. And so I don't really particularly like the risk reward, but I won't talk people out of selling premium because it does work for some people. But I will talk people out of buying options going into earnings. It just doesn't work. So don't do it. So that's that. If you are on the stream and you have questions about something to look at, just speak up, make a comment. More than happy to look at things. I do this to help teach. All right. So I want to kind of finish out by looking at some instruments this week that myself and other people in the chat were trading in my Discord and other things like that. So one that I was unfortunately not in, but I did appreciate was Starbucks. Wow. I've been talking about this to people that wanted to buy calls on this a few weeks ago, and I dissuaded them from it because I just didn't think that you were going to have a big move in a coffee company. But that's why you have to make your own choices. Don't listen to just me when that's why I don't tell people absolutes what not to do, except when buying. Strategically, I tell people not what to do, but individual trades, even a bad trade can work. And so I'm not going to go on the record saying that this trade in particular is not going to work, because it might. And then they're not going to listen to good common sense because they happen to get lucky. So I don't say something not to do, but I will try to dissuade people from things I think won't work. So Starbucks had a very nice little dip here. Now, that's not what was played. I think the reason that someone played it in Discord is because on a down day, I think the day after the crash this week, Starbucks was being very resilient. See, that's an example. Starbucks, if you look, is a strong stock. And so when you have a big down move like Monday, what this actually ended up doing was bringing it down to a really clear support level from the low here it made in June all the way up to the high right here. Gorgeous, gorgeous support level that it held 50% level and then launched off of it. The reason I want to talk about this first is it segues from talking about earnings plays. What do you have coming up here on the 27th, which is next week? You have earnings. You're getting a huge move coming up into earnings. Now, I already said don't buy options right before earnings. No, don't do it. But in the days and weeks before earnings, you can see this a lot. I try to make people really focus on this. If you're going to make an earnings play, do it 2 to 3 weeks out. That's how you make money on earnings, because not only are you getting this delta move on the stock going up, going into earnings on some hype, some news, some rumor, I don't know, stock's moving. That's all I see. Not only are you getting this benefit of a delta move, you are also getting the benefit of volatility increasing, IV pushing up. Let's take a look at this. I'm using Thinkorswim because I can see the volatility. So I have an indicator here on the bottom that's showing me implied volatility. So right around here where it started out, that's just a good starting point. You see this move going up. Volatility, implied volatility, the average implied volatility went from 21 to 30. That's a 10-point move in volatility just in the last month. And so you've got earnings coming up on the 27th, which is basically right here. So about how long has IV been increasing? From the low it made right here is about 44 days, about a month and a half. But if you go out to, let's say, about 2 to 3 weeks, you're able to catch it on the upswing. So not only if you bought a call in here, not only are you making the delta movement, but you're also benefiting from the implied volatility rising. So double whammy, making your option worth so much more. And then you must close it before earnings. Cannot stress that enough, because not only is it a 50-50 shot, but that IV is going to tank. It's It's going to collapse. Just like it did here on the last earnings back in April. Boom, drops off immediately after earnings. What about this slide? Oh, see, run up to earnings here. Earnings, boom, IV tanks. Last earnings, nice steady move up in IV. Those options getting priced more and more. Boom, IV drops off. You can't hold options through earnings unless they're dated out another expiration, another earnings cycle. If you have still 150 day till expiration option at earnings, you can hold that for maybe 2 cycles. But if you have no more catalyst in that option, get out of it. Just don't do it. Just don't hold through it. Don't think that you know better. It's just the same thing as buying it the day before. Even if you win, you still lose. So that's Starbucks, good win. And there's no reason why the people that are holding calls should not hold this until right before earnings. So that is going to be 727 aftermarket. You can hold it until 355 on 727. I'm not going to say a word to you. So that's how you play earnings. You play earnings in the weeks leading up to them, not the day before. Don't do it. Don't do it. I got some questions from folks about a stock I've been talking about for the last couple of weeks, which was NVIDIA. So NVIDIA, I was able to catch on this realm right here, and got on this dip right here, held through this volatility, and then on, let me just take off Ichimoku because it's not really necessary. As this was coming up, they announced on, I think it was the 20th, that they were going to do a stock split. And so at that point, I was long this stock because of the stock split hype. Normally, what I was going to do was hold it just through earnings, then close it out completely. But I changed things up a little bit. I held some for the run up. Now, I could have sat back and said, oh, this is just going to be just like Tesla, just like Apple, and this is going to run up and on the split. And it did. But I closed out a good portion of my position because I had shares on earnings. And somebody asked me why I did that. That confused them. It's going up. And in hindsight, it worked out great. I've just been in this game long enough to know. Again, earnings is a crapshoot. And this is really relevant because if you notice, all these earnings are coming up. We're in earnings season. All these companies, they release earnings once a quarter, and they all kind of group together within a few week period, like about a 4 or 5 week period. So this is what's going to be moving stocks right now is earnings announcements. I've just seen so many disasters that I want to de-risk going into earnings, even if I am very convicted on it going up, because it's going to be a lot harder for me to make up that loss. As long as I stay in a little bit, I can still get the gains. I'm content. But I just know what I know viscerally. I've experienced. I've taken the pain of being in some earnings that goes against you. Or I've been watching a stock and I've seen it drop tremendously on earnings. It makes me sick to my stomach that I wasn't, that if I had been in it, because if stock drops 15, 20%, whew, it can happen. It can definitely happen. So that was NVIDIA why I got out. But, I was able to catch it here. And then as it went up, a lot of people towards the end here, I know I was reading their comments and, Discord and also in the live streams when I was talking about it, people were leaving me comments right around here. Like, what do you think the price action tomorrow is going to be on NVIDIA? It's almost like clockwork that people started asking me about NVIDIA when it was up here, right before this dip and right before this dip. It's like clockwork. You'd think when people were buying up here would keep pushing it up, but people that waited this long to play the stock split, they got burned. Not just you, Jen. Not just you. If it makes you feel any better, there's a lot of people that do what you do, but you're getting there by recognizing what you do wrong. You're getting there actually, because the thing is, people are just going to keep making these same mistakes. I think that a lot of the gains that professional traders make is profiting from other people doing stupid shit. I think once you eliminate some of the stupid shit, you got a pretty good chance, because there's a lot of stupid shit that you can do. Anyway, so how I played my exit on this is I let it top out, and I knew my strategy going in was I was going to wait 2 days after the stock split. The reason for that was really just simple. I looked at Apple and I looked at Tesla, two comparable stocks, and their highest points after the split was 2 days afterwards. So even though on the day before the split, we had a little pop up, and the split itself was a negative day, I waited 1, 2 days, and it just so also happened that technically speaking, I wanted to get out because, and I've talked about this in live streams and videos, and it probably deserves its own video too, or a master class that I charge people for. I'm not gonna do that, but it's really simple. I'll tell you, here's a secret. Wait for the reaction. And when I talk about reaction, I'm talking about this. Basically, you have something make a high and it comes back as a little trend in a trend. If you zoom down, you can see it's a trend in itself. Okay, so that's a trend of people profit taking, selling off, whatever you want to call it. Then, just like I'm looking for entries, I'm going to measure that out from the top to the bottom. It's really easy to see. Top to bottom, boom. And then look to get out on the 50%. And so by day 2, when it was pushing above, I've got a technical level, I've got my fundamental reason that I plan to get out of it. And so around 195, around in this bar right here is where I got out, and I'm content. Now it could keep going up. I'm going to look at another trade, Etsy, here in a minute. Stocks can keep doing whatever they want, but you've got to make an exit, and if you wrap it around some kind of a strategy, you're going to be so much better off because it's going to remove that emotion. People say get the emotion out of trading. Don't necessarily agree with that comment, because I think that a lot of trading is pattern recognition, and pattern recognition comes from intuition, and intuition is based on emotion. But wrapping your trades themselves around some kind of structure is what makes or breaks a trade, because it keeps you honest, keeps you from falling victim to yourself. So I'm happy with NVIDIA. Good trade. Wanted to share that. Got a question in the chat. Question about Ichimoku. If price is above the cloud and then price then goes down and enters the cloud, does it matter to you the color of the cloud? Good question. There can be a lot of answers to this question, because when you're in a consolidation like this, the cloud is going to flip, because what's happening is you have the Senkou B, or Senkou B, however the Japanese pronounce it, and the Senkou A, and they are measuring the highs and the lows, 50%, and they're shifted forward. And so when you're consolidating and price is chopping around, the cloud's going to go bullish, the cloud's going to be bearish. There are some people that study the cloud flips. When I was studying Ichimoku for years, I did study the cloud flips. And you can go and you can find instances where the cloud flip in itself, if you just kind of look with your eyes, like most technical analysis, you can see where when the cloud flips, sometimes it can be a turning point in the stock. Ooh, I just dazzled you there with, something that looks fine. You got to be careful about with technical analysis, because I can always find places where it did work, and then if you look hard enough or you actually do some rigorous statistical analysis, you can see that, well, that's where the cloud flipped there, but that's not exactly where it did an actual turn. The turn came multiple bars later. So is it really valid? That's why I kind of flip back and forth between Ichimoku and no Ichimoku, because at the end of the day, you need to focus on price action. And so this is a roundabout way of saying you really don't need to think about Ichimoku that much in depth. You need to be as simple as you can in your trading and then layer on top of it. So my point there would be just look at price versus the cloud to tell you if you're in a bullish or a bearish scenario. And then from there, if you want to look at it more, if you want to dig into it more, join Discord and ask questions, and I'll try to help you along the way. That would be what I would say there. But don't want to overcomplicate things, because I studied Ichimoku for years and years and years, and I pulled out my trading methods from Ichimoku. But I've gone backwards to the point where I'll make it a point to take it off so that I can see more clearly. So I sometimes don't want to have the color flipping, because that's going to make me see things that maybe aren't there. And that's the danger in having too much technical analysis indicators. So hopefully that answers your question there. But I definitely recommend people study Ichimoku. There's a lot that you can do with it. A lot. So find what works for you. And what works for me in Ichimoku was simply, looking for trends and trend breakouts. One of the things that I made a post about when it happened was the Ichimoku cloud breakout on Bitcoin. Made a video about it, tried to warn people. A lot of people poo-pooed it because they don't believe in technical analysis. Well, at their expense. As soon as price got below the daily cloud, daily being key, it had not violated the daily cloud since October of 2020. Up it went. Kind of little got down below here, but notice how your Chicago, your momentum did not get out. Still bullish. But the moment you started getting into a situation where you had both price and your momentum, which would happen somewhere around here, getting out of the cloud, you have a confirmation that a bearish trend was setting up. First time it happened since October. And people that ignored this because they thought it was a dip to buy, or they believed that Bitcoin was the future, well, they were wrong. And as it stands right now, Bitcoin is still below the daily cloud. Bitcoin is still in a bearish trend. Bitcoin does not get bullish again until it gets out of the cloud. And for me, momentum gets out too. So Bitcoin does not become bullish to me until really the high 40Ks. I'm just not going to be looking for long-term bullish on this. I'm not going to be recommending it to people. It's still bearish. Go back and look at the daily cloud on Bitcoin using the classical settings, not the Zoomers and what they're using for crypto because they think it's better. Use the classical settings and see how powerful that daily cloud really is. And so that's one of the things that I definitely use with Ichimoku, just the simple cloud and then the momentum to tell me, is the trend bullish or bearish? And then the other thing that I learned from Ichimoku is, of course, the 50%, because all of these lines are going flat at 50% levels. And I really love it when price pulls back to the cloud. What was that? Yeah. So, it can set up some really, really good setups at the 50%. Let's see, was it Etsy, the one I want to talk about? On the weekly, where was it? What is it that I'm I should have this list set up for things. Okay, so that's what I learned from Ichimoku was the 50%. So happy to help people in studying those things. I love Ichimoku, but you can't get entirely married to it. So real quick, look at some. There was another trade I want to look at. Etsy. Etsy this week has been ripping with tech. Kind of gave me a little bit of a problem on Monday, but it did not stop me out, which was good. Reason I got in goes back to these spikes. This one in particular, right here at the open. I tell people to look for these spikes at the open. I showed earlier in the podcast or the live stream the 5-minute. We'll look at that here at the end. We'll look at the how you should have traded the ES. Really good opportunities there coming off that bottom. But Etsy is one that I wanted to kind of review because I got into this on, I think it was like last week. The end of last week was the 15th. The 15th was Thursday. Yeah, the Thursday of last week, and got into that one. And I was looking for some kind of an exit up around the highs right here. So look to buy on where that spike would give me a little pullback with a stop just below it. And I was looking for some kind of a target around this realm. I think it went for a 3-to-1. So yeah. So what happens here is I would have an alert to alert me when it gets up to these levels. And then I was watching, there's a scare, and then up it goes. And at that point, now I've got an alert where I need to start being a little defensive. So what I'm going to look for in that case, if you remember looking at what we were talking about earlier, that NVIDIA, when something makes a major level, when it comes up to the level that I have marked off, triggers my alert. Now I'm looking for it to get back below the red line, which in Ichimoku is the Tenkan-sen or the 9-period median, whatever you want. So I'm going to wait for it to get below that level, and boom, I'm going to exit my position on that pullback right there. So as it comes up, yeah, I didn't get the high right there, but I let it have a reaction and then pull back to its local 50% from that level, and that's going to give me an optimum exit. And measuring from my entry down here with the stop below the low, just to pull out the initial trade, was about a 4.67 to 1. And I left some on in a long-term holding portfolio. Now, was this the perfect exit? No. But I'm not going to be that upset about it because in most cases, this works and it keeps me honest. And I left some on for the long term to play the rise up because you never know what it's going to do. I want to hold Etsy because I want to hold it in the Becky portfolio. So this was a great opportunity to get some Etsy, some more Etsy. Yes, you did. You did get some Etsy. Good for you. So that's just an example of what I look for to get out of positions. I'm going to have alerts set where I think this price is going to go. It's going to trigger that alert. I use Thinkorswim, or you can use TradingView, and then look for a reaction off that level. You get a reaction, you know that your level was correct. Now, don't panic sell it. Wait for it to pull back because it's still a bullish trend. You're probably going to get a good exit, and then you can get out at an optimal exit. Give up a little bit of profit from the top, but you never know what could have happened. You could have kept on rising, never got below that red line, and you could have gotten even more. So that's another thing to look at. So one thing that people traded, when I talk about trying to play a bearish market correction, don't buy SPY puts. There was another one which I looked at last week. This was, of course, Tesla for a short term. There was a spike on, where's that at? Show me my spikes. There. So Tesla, and we don't need Ichimoku because it's going to distract us. If we look here, this is not, it's a bullish stock, but it's not going directly up and to the left like SPY. Now, I know a lot of people are Tesla fan boys and girls, but it's still a little weak. If anything, you could say that it's inside of a consolidation. And so if the market is going to go down, Tesla is going to suffer a little bit more than anything else. And so going into this week and into the crash, it was good to be able to set up a short setup. And what I really liked here was, we'll bring back Ichimoku here because there's my level. What this setup here was a 50% off of the reaction that happened in the morning right here. And so this was something that you could have put on, boom, smacked it right at 10 a.m. and you could have pulled out a hedged entry. Now you're into the 13th of July. Let's see what we ended up happening on that Monday. So 14th. Let's go to the 2 hour, speed this up. I'm impatient. And then boom, right there on this Monday, you would have gotten that extra bonus because again, You were in a weak stock and it tanked like the rest of the market, and you could have taken profit down here at the low. So if you think that the market is going to come off an all-time high, I mean, just think about it. The market's making all-time highs. Tesla's not making an all-time high. So if you think the market's weak, find weak stocks. Stocks like Tesla have a lot of options and a lot of things to play, and play them to the bear side. That's how you play a bear market. You find opportunity within the bear market. Don't try to short the whole market itself, especially when it's ripping. So that's an example of how you can put on a hedge in a bull market. How you can, yes, if a market goes down, your stocks are going to go down. Simple solution to that, don't be so big and look for short opportunities. See what else? As we're wrapping up here, Apple. This last week was a great time to be Apple. This is why people should not have panicked. Apple set up a really, really nice dip here. We've been talking about, I mean, everybody's talking about Apple. Basically, Apple made a new all-time high. It broke that one and had a few days above it. People might have bought that breakout. Don't do that. If you get a breakout like this, if you break out of an all-time high, there's a really good chance price will come back to test it and give you another opportunity. Look for that. And so this week I was able to pick up some Apple in here. Now it was a little dicey. We'll dig down. I'll go exactly how I played it. So on this one, what I was looking at was it to come back to a reaction. So what I did was I played it here. I'm not going to sit here and tell you that I got it perfectly, boom to boom, but my stop was just below the low here. I don't want it to break there. So long here, sweat out the stop, and then even if we give it just a 3-to-1, by the end of the day, I think it was Tuesday, I was already able to take some profit up in here. And then still have it for the longer term, because who doesn't want to own Apple? So great opportunity for those that were non-emotional to pick up a discount on Apple, which is also a retest of the all-time high to now hold it and make some new all-time highs. Great setup in Apple this week. What else? Philip Morris, which I like a lot. They've got earnings coming up, but doing a whole lot of nothing. Still like that for a dividend play. And just today, Clorox. Clorox gave me an entry here, which if you look on the long term, I think this is holding at this level right here. Yeah. So from long term consumer staple, which I like. We'll look at some, let's see, consumer staples. Look at the ETFs here in just a second. But somebody asked me this week, I got a friend that really wants to get long the market. They're afraid of missing out. They're FOMOing. What should they buy? If you want to be defensive, look for value companies, consumer staples, healthcare, utilities. They move slower, but they're more resilient in a market crash. I put a video about sector rotations, one of my most popular video series. And so study sector rotation, and you'll start to see what's happening in the market. Really quickly, if you just look back at the last, let's look back at the last 2 weeks and see what's been happening. Energy has been the big loser in the last week itself. Technology, consumer discretionary. It's almost like we're in a growth period. It is. It's weird. But those are the ones that are outperforming. But man, they've had quite a run in this last quarter. Technology has resurged. The inflation trade has wound down. So, going to wrap it up here. Oh, you want to look at Kroger? What's Kroger doing? I'm mad at Kroger. I told you about being mad. Oh, man. Yeah. You know, Kroger is good to own. I mean, I shop at Kroger pretty much exclusively. I just wish they paid a higher dividend, but yeah, it's good. I'm mad at them though. I'm mad at them for closing my favorite store down the road here. I'm going to find another store. I already talked to you about that. But again, that's just like these people playing options around earnings just because they like the company. So trade wisely, guys. Have a good weekend. Come back fresh tomorrow. There's always going to be opportunity. Just have your butt in the seat and be disciplined. So see you later.